Welcome to StokTok's deep dive into ING Groep. ING is one of Europe's largest banking and financial services groups, operating retail banking, commercial banking, and wealth management across dozens of countries. As of May 5th, the stock is trading at $28.41. Over the past 52 weeks, the stock has traded between a low of $20.07 and a high of $31.18. The stock is currently positioned above its 50-day moving average of $26.77 and above its 200-day moving average of $25.72. The Relative Strength Index, or RSI, is sitting at 56.4, which is neutral territory. Let's work through the fundamentals, scene by scene, starting with a quick business overview. ING generates revenue from three core pillars: retail banking, where it provides mortgages, deposits, and consumer lending; commercial banking, serving small and medium enterprises and large corporates with lending and treasury services; and asset management and wealth management, offering investment products and advisory services. The competitive moat stems from its scale across Europe, cost efficiency in operations, and customer switching costs in retail and deposit franchises. The StokTok score for ING is 27 out of 100, signaling caution. Breaking that down, valuation scores 7 out of 20, financial health scores 2 out of 20, profitability scores 6 out of 20, growth scores 10 out of 20, and smart money positioning scores 2 out of 20. Now, valuation. The question every investor has to answer: are you paying the right price? ING is trading at a price-to-earnings ratio, or P/E, of 11.22 times on a trailing 12-month basis. That forward P/E is 10.11 times, suggesting modest near-term earnings growth is being priced in. The PEG ratio, which divides the P/E by the earnings growth rate, stands at 2.48. For context, a reading below 1 often signals undervaluation relative to growth expectations, while above 2 can indicate stretched multiples. The price-to-sales ratio is 3.18 times. The enterprise value to EBITDA multiple shows 0.00, which reflects distortions in the bank's accounting structure and is not meaningful for comparison. In our view, the competitive moat here is moderate. European banking is a mature, highly regulated, and competitive sector. Our DCF model suggests the stock is trading at a 23.12% discount to intrinsic value, which would ordinarily be compelling. However, that margin of safety narrows if earnings forecasts disappoint. On the latest earnings in Q2 of 2025, ING reported earnings per share of $0.64 against an estimate of $0.61, a beat. Revenue came in at $5.82 billion versus the $24.61 billion estimate. This appears to be a significant miss on the revenue side, and the growth rate year over year was only 0.4%, essentially flat. However, the stock surged 3% in after-hours trading following the announcement, suggesting the market was relieved by the earnings per share beat and the strong net income figure of $1.56 billion. Wall Street analysts have a consensus mean target of $31 on the stock, with a high target of $34 and a low target of $28. That mean target implies about 9% upside from current levels. Market sentiment around ING leans bullish. The company has demonstrated positive momentum through completion of share buyback programs and announcement of a new €1 billion repurchase initiative. Additionally, strategic acquisitions are strengthening ING's European banking footprint, and successful shareholder meetings reflect management confidence in long-term value creation, despite geopolitical headwinds from the company's decision to exit the Russian business. From a valuation standpoint, the setup looks interesting to us, but the microscopic revenue growth and execution risk warrant caution. Moving to financial strength, how solid is the foundation? The Piotroski F-score, which is a 9-point financial health checklist, comes in at 2 out of 9 for ING. This is a red flag. The F-score evaluates profitability, leverage, liquidity, and operating efficiency. A score below 5 generally suggests deteriorating financial health. The Altman Z score, a bankruptcy risk model, registers at 0.00 for ING. This is a distress signal and reflects the structural nature of banking industry balance sheets, which use different accounting conventions than manufacturing or industrial companies. The Z-score model was originally designed for non-financial firms, so interpreting it literally for a bank can be misleading. However, the zero reading warrants acknowledgement. Turning to the balance sheet itself, the cash-to-debt ratio is 0.38, meaning the company holds only 38 cents in cash for every $1 of debt. That is a tight position. Interest coverage is not applicable for this banking model because net interest margin, not operating income, is the relevant metric. The current ratio, a measure of short-term liquidity, shows 0.00, again reflecting banking balance sheet structure where assets and liabilities are marked to market daily. Debt to equity stands at 3.60, which is elevated. For context, many industrial companies target ratios between 0.5 and 1.5. A 3.60 leverage multiple suggests ING is carrying substantial financial leverage. The bear case rests on the combination of weak F-score signals, elevated leverage, and thin liquidity buffers if market conditions deteriorate. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, is 0.00, which signals that the capital deployed in the business is not generating returns above the cost of capital. That is a structural challenge. Gross margin is 0% because banking does not employ that metric. Net interest margin and fee income are the relevant profitability measures. Operating margin is also 0% for the same reason. Net margin, however, tells us the bottom line story, 27.74%. That means for every dollar of revenue, the bank converts roughly 28 cents into net profit. That is genuinely strong and reflects ING's ability to manage costs relative to its earnings base. However, the free cash flow margin is negative 29.22%. This means the business is consuming cash despite high reported earnings. This is not uncommon for banks, where accounting earnings and actual cash generation can diverge due to loan loss provisions, working capital movements, and funding needs. The divergence between strong net margin and negative free cash flow margin is material and suggests the reported profitability masks underlying cash generation challenges. In context of the Q2 2025 results, the net income of $1.56 billion was substantial, but the revenue miss, the actual revenue of $5.82 billion versus expectations of $24.61 billion, raises questions about the sustainability of that profit level if growth remains stalled. Onto growth, is this business expanding and at what rate? Revenue growth over the trailing 3 years averaged 6.6% annually. Over the past 5 years, revenue growth averaged 12% per year. That 5-year rate masks a sharp deceleration. The most recent quarter showed revenue growth of only 0.4% year over year, essentially flat. That deceleration is the single largest concern here. Book value growth over the trailing 3 years was 7.5%. Which is stable but uninspiring for a financial services franchise. The dividend yield is 4.35%, which is elevated relative to broader equity market yields. A high dividend yield can signal value, but it can also signal the market is pricing in limited near-term capital appreciation and is instead capturing yield. When we layer in the revenue stall, growing at only 0.4% in the recent quarter against a historical 5-year average of 12%, the picture becomes concerning. The market may be saying growth has hit a wall. Management guidance at the next earnings date, scheduled for July 30th, 2026, will be critical. The consensus earnings per share estimate is $0.69, suggesting flat to modest earnings growth. If actual results fall short of that forecast, the yield trap dynamic could reverse quickly. Now let's talk smart money. What institutional capital is actually doing with this name? According to Dataroma, which tracks the 13F filings of top-tier value investors, 7 gurus currently hold ING. However, the position sizing is modest and conviction is mixed. Sarah Ketterer at Causeway Capital Management holds 0.38% of her portfolio in ING, but she reduced that position by 38.56%, a clear sign of declining conviction. Richard P. Zena at P. Zena Investment Management holds 0.01%, which is minimal, but he added to the position with a 17.02% increase. The broader institutional picture: only 2.9% of the 13 F filers tracked are net buyers, meaning greater than 50% of their positions are in buy mode rather than sell mode. That is low institutional interest. Insider ownership at ING is 0.0%, which is unusual and concerning. It suggests company management owns virtually no shares, creating a potential misalignment of interests between insiders and shareholders. Over the past 3 months, there have been 0 insider buys and 0 insider sells. No insider activity whatsoever. That lack of skin in the game, combined with the mixed signals from big value investors who are either trimming or staying very small, tells us that smart money is not rushing into this name. The divergence between the modest analyst targets and the guru reductions is notable. And finally, the verdict. Let's bring it all together. On valuation, the DCF model suggests a discount to intrinsic value, and analyst targets imply modest upside, but that margin of safety hinges on the company stabilizing revenue, which contracted to near zero growth in the latest quarter. On financial strength, the Piotroski score of 2 out of 9, an elevated leverage of 3.6 times debt to equity, raise structural concerns about balance sheet resilience. On profitability, the strong net margin of 27.74% is offset by the alarming negative 29.22% free cash flow margin, suggesting earnings quality is questionable. On growth, the sharp deceleration from a 12% 5-year average to 0.4% in the most recent quarter is the thesis killer. This is a mature, slowing business. On smart money, insider ownership is 0 and guru conviction is either declining or minimal, with only 2.9% of institutional filers acting as net buyers. The Q2 2025 earnings beat on earnings per share was welcome, but the revenue miss and flat growth trajectory suggests the beat may not be repeatable. In our view, the case for ING rests entirely on a turnaround in growth and credit quality that is not yet evident in the data. The setup does not look compelling to us. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on ING Groep. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.